Hello and welcome to the first of our series of videos on CIMA F3. These videos are based on express notes which you can download from the website www.theexpgroup.com. I suggest you download them now because whatever we will do will all be based on those notes. Now in this first video, what we will be doing is we will look at the way the financial strategy is formulated and in general what financial strategy is. If you look at the bottom of the first page of chapter 1, you will see the big picture where it basically says that a financial strategy is first of all a part of an overall strategy of an entity. So its objective, the objective of the financial strategy, is to make the organization achieve its goals. Now, we will be dealing with obviously the financial bit of those goals. Therefore, we will look first at what those goals, what those objectives might be. Any organization will have financial and non-financial objectives. In the exam, you will be mostly looking at profit-making companies. The primary objective of those is always maximizing the wealth of their shareholders. Therefore, they are deeply interested in financial measures. Financial considerations are of prime importance to them. They might have other objectives, obviously. They might want to support environment. They might want to engage in progressive labor policies. They may want to enhance their reputation. However, in general, all commercial companies, their primary objective will be to maximize shareholders' wealth. Now, having said that, you may also encounter other types of organizations in the exam, like not-for-profit organizations and public sector entities. For both of those, profit-making will not be their primary objective. Not-for-profit organizations, well, by definition, they will not want to make a profit. Their objective is to provide certain service to the community. However, even then, they need to think about the cost of providing this service. Therefore, they will introduce some cost controls because obviously their resources that they have are limited, and within those limited resources, they're supposed to provide service which is as good as possible. That's why for not-for-profit organization, the key importance will be in the 3 E's you may have met earlier in your studies. So economy, efficiency, and effectiveness. Public sector entities, again, they're not supposed to make a profit. They're not there to make a profit. Again, they are there to provide a certain service to the general public. Again, what matters most is the quality of that service. Take the example of a hospital. Obviously, we all want to go into a clean, nice hospital with high level of medical care. Having said that, again, you will have some restraints, some restrictions, because obviously these entities will also be subject to some budgetary limitations and controls. Now, from our perspective now, if we look at the commercial entity, we will have the financial objectives as the primary objectives. We will know that they must meet their goals in terms of maximizing the shareholders' profit. And in order to do that, obviously they need to have some financial strategy. The financial strategy will always be about making three decisions. Decision number one will be about investing. We know what we want to maximize the shareholders' wealth. We are in a certain business, and therefore we need to decide how much and how to invest it in order to get as much return as possible in terms of return on investment, net present value, achieving the result higher than internal rate of return or cost of capital. Well, all that is an investment decision, and that's the first part of financial strategy. The first part is about deciding what to buy, how to invest the money. When we have decided on that, it comes number two. Number two is about, okay, so where do we take money for that investment? We already said that investment will be good. It provides the relevant IRR, it provides a good NPV or return on investment, or payback period is okay, or whatever. We decided that this investment is worth going for. Now, how do we finance it? Have we got equity that we can spend on new investment? Or maybe we have to take some debt. Or maybe it is better to take debt to finance that investment because it has a huge IRR which will cover the cost of debt. Or maybe we should postpone payments to our suppliers to accommodate cash that will be used in those investments that we selected. Finally, maybe we will do a mix of all these, right? What kind of mix? What can we do? Because on the one hand, we may not be able to raise any more equity. We cannot do it. On the other hand, we may not be able to raise any more debt. Right? So there is a number of situations, and similarly, we may not be able to postpone our suppliers any further. So there is a number of situations which we need to take under consideration here. But anyway, when we have decided what to invest in, the second thing is how to pay for it. And then decision number three, because obviously told you there will be three decisions, is okay, how about dividends? Our shareholders want to get their money back in some way. So we will need to have some dividend policy for them. Now the question is what sort of dividend we will pursue. That will be actually subject, the exact dividend policy will be the subject of our second video, but here just to indicate that the third part of financial strategy is our dividend strategy. So how much will we pay back to our shareholders? Will we pay something back to our shareholders at all or not? And that, in most cases, will simply depend on who our shareholders are. And the last thing to deal with in this video is the concept of matching, or something that's also sometimes referred to as the golden principle, which basically means that our short-term assets should be financed from short-term liabilities, while our long-term assets should be financed from long-term liabilities. What it translates to, in fact, is that when we have fixed assets, it is sensible to buy them incurring liabilities that will also have a long-term nature. Clearly, if we buy a factory building that will generate income streams for another 20 years, it wouldn't be sensible to finance it with an overdraft, because overdraft must be repayable on demand, and therefore the income streams from that building might not yet come to us before we have to repay the overdraft. So whatever assets we have that are long-term in nature, they should be financed from long-term liabilities. And that will include fixed assets and sometimes the concept that is called permanent portion of current assets, like certain stock levels that we don't want to go below. Now, current assets will be financed from short-term loans. They can be financed from short-term loans because they have a high turnover ratio. They generate cash on a recurring and short-term basis, and therefore they will generate cash to repay the short-term liabilities. That does make sense. That's why it's called the golden principle, because it simply makes sense.